The financial world is abuzz with talk of a looming recession. Headlines scream about market volatility, and economists paint a bleak picture of the future. It's easy to get swept up in the fear and uncertainty, but remember, every storm eventually gives way to sunshine. As an investor, I see this not as a time to panic, but as a time to prepare, to position ourselves for the rebound, for the opportunities that always follow a downturn. This isn't about predicting the weather, it's about being prepared for any weather. For decades, I've navigated market cycles, witnessing firsthand the ebb and flow of the economy. And let me tell you, those who fearfully retreat to the sidelines during times of uncertainty often miss out on the greatest opportunities. The key is to approach these moments with a calm head, a long-term perspective, and a sound strategy. In this video, I'm going to share with you 5 key steps to protect your financial future in the face of a potential recession. These are the same principles that have guided me through decades of market fluctuations, and they remain as relevant today as ever. The first and most crucial step in preparing for a recession is ensuring you have ample liquidity. Now, what do I mean by liquidity? I'm talking about having readily available cash or cash equivalents that you can access quickly without having to sell assets at potentially unfavorable prices. Just like a strong fortress needs deep moats and sturdy walls, your financial well-being requires a solid foundation of liquidity. Think of it like this. When the economic tide goes out, as it inevitably does during a recession, you don't want to be caught stranded, forced to sell your assets at low prices just to stay afloat. You want to be the one with the resources to capitalize on the opportunities that emerge. Having sufficient cash reserves provides you with the flexibility and peace of mind to weather the storm. It allows you to cover your expenses, meet your financial obligations, and, most importantly, take advantage of attractive investment opportunities that may arise during a downturn. Now, I understand that building up cash reserves takes time and discipline. It's not always easy, especially in today's world of instant gratification. But trust me, the peace of mind that comes with knowing you have a financial cushion to fall back on is invaluable. Start by reviewing your expenses and identifying areas where you can potentially cut back without drastically impacting your lifestyle. Consider setting up a dedicated savings account specifically for your emergency fund and treat it like any other essential expense. Remember, building a financial fortress takes time and effort, but the security it provides is well worth the investment.
Now, you might be thinking, Warren, you just emphasized the importance of liquidity, of having cash on hand. But now you're saying cash isn't always king? And you'd be right to ask that. While cash provides stability, especially during turbulent times, it's crucial to remember that it doesn't grow on its own. In fact, over the long term, inflation can erode its purchasing power.
Think of it like this. If you bury $1 in your backyard today and dig it up in 10 years, it'll still be $1. But will that dollar buy you the same amount of goods and services? Likely not. That's the insidious nature of inflation. This is where the concept of zero growth assets comes into play. These are investments that offer little to no potential for growth, such as traditional savings accounts or low-yield bonds. While they might seem safe and secure, especially during times of market volatility, they can actually be detrimental to your long-term financial health. Let's look at the stock market. Yes, it has its ups and downs, but over the long run, it has consistently trended upwards. This is because the stock market represents ownership in businesses, and businesses are engines of innovation and growth. By investing in stocks, you're essentially participating in the growth of the economy. Now, I'm not suggesting you go all in on stocks, especially if you're approaching retirement or have a low-risk tolerance. But it's essential to understand that avoiding growth altogether can be just as detrimental as taking on too much risk. The key is to find a balance that aligns with your financial goals, risk tolerance, and time horizon. Chapter 3. Adopting a myopic attitude, tuning out the noise.
One of the biggest mistakes investors make, especially during times of uncertainty, is becoming overly fixated on short-term market fluctuations. They panic when the market dips, forgetting that the stock market is a marathon, not a sprint. They try to time the market, to buy low and sell high, but more often than not, they end up buying high and selling low. The truth is, no one can consistently predict market movements with any degree of accuracy, not even me. I've been at this for a long time, and I've seen countless experts make bold predictions only to be proven wrong by the market. That's why I advocate for what I call a myopic approach to investing. Instead of trying to predict the unpredictable, focus on what you can control your investment strategy. Identify high-quality businesses with strong fundamentals, invest in them for the long haul, and let the market do its thing.
Remember, recessions are a natural part of the economic cycle. They come and go. But the stock market has always recovered from downturns time and time again.
In 2008, during the depths of the financial crisis, I wrote an op-ed for the New York Times titled, "Buy American, I Am." At a time when fear and panic were rampant, I saw an opportunity. I knew that the American spirit of innovation and resilience would eventually prevail, and I was right. The key is to tune out the noise, to ignore the short-term fluctuations, and to stay focused on your long-term goals.
Chapter 4. Weathering the storm, investing in companies built to last.
When a recession hits, it's like a strong wind that blows through the economy, exposing the weaknesses of poorly constructed businesses while leaving the strong ones standing tall. That's why it's crucial to invest in companies with a proven track record of weathering economic storms. I'm talking about companies with strong fundamentals, solid balance sheets, consistent earnings, and a competitive advantage in their industry. These are the businesses that are built to last, the ones that can withstand economic downturns and emerge even stronger on the other side. Think of companies like Coca-Cola, Apple, or Amazon. These are all businesses with strong brands, loyal customer bases, and a history of adapting to changing market conditions. They've weathered numerous recessions and economic crises, and they've always come out on top.
Now, I'm not saying that every blue chip company is a guaranteed winner. You still need to do your due diligence to understand the business, its industry, and its management team. But by focusing on companies with a proven track record of success, you're increasing your chances of navigating a recession successfully.
Remember, investing in the stock market is about owning a piece of a business. And just like you wouldn't want to own a business that's poorly managed or overly vulnerable to economic downturns, you shouldn't invest in companies that exhibit those same weaknesses. Look for companies with a history of innovation, a strong competitive moat, and a management team that's aligned with the interests of shareholders. These are the businesses that are best positioned to weather any storm.
Chapter 5. Staying the course, the power of patience and discipline.
One of the most important lessons I've learned in my decades of investing is the power of patience and discipline. It's easy to get caught up in the excitement of a bull market, to chase after the latest hot stock, or to panic when the market takes a downturn. But the most successful investors are those who can tune out the noise, stick to their investment strategy, and stay the course.
Remember, investing is a marathon, not a sprint. There will be ups and downs along the way, but by remaining patient and disciplined, by focusing on the long term, you're putting yourself in the best position to achieve your financial goals.
Think of it like this. When you plant a tree, you don't expect it to grow into a mighty oak overnight. It takes time, care, and patience. You have to nurture it, water it, and protect it from the elements. And even then, there will be seasons of growth and seasons of dormancy. Investing is no different. You have to identify promising companies, invest in them for the long haul, and allow them the time to grow and compound your returns.
There will be times when the market tests your patience, when it seems like your investments are going nowhere. But it's during these times that it's most important to remember your long-term strategy and to stay the course.
Avoid the temptation to panic sell when the market dips. Remember, every downturn is an opportunity to acquire more shares of great businesses at discounted prices. As Baron Rothschild famously said, the time to buy is when there's blood in the streets, even if the blood is your own.
Of course, I'm not suggesting you go out and buy indiscriminately during a market crash. But if you've done your research and you're confident in your investment thesis, then a downturn can be a great opportunity to add to your positions.
Reaping the rewards, your journey to financial freedom.
As we've discussed, preparing for a recession isn't about predicting the future. It's about positioning yourself to weather any storm and emerge stronger on the other side. It's about building a solid financial foundation based on liquidity, long-term growth, and a disciplined investment strategy.
Remember, the market rewards those who are patient, disciplined, and who stay the course. Don't let fear or uncertainty derail you from your financial goals. Instead, use this time to educate yourself, to refine your investment strategy, and to position yourself for long-term success.
Take advantage of these moments. Invest smartly, be patient, and remember that the market rewards those who stay the course.
Subscribe to this channel for more insights and strategies to navigate the world of finance and build a brighter financial future.